In this week's video, we'll cover numerous charts that tell us to remain open to higher highs in the S&P 500 before year end. When the stock market is consolidating as it's been for the past several months, it speaks to indecisiveness, so it can be helpful to simplify things. And one of the ways that we can do that in a bull market is to continually ask, does it still look like a bull market? If the answer is yes, then we know that bull markets make a series of higher highs and higher lows. Therefore, if the present day still looks like a bull market, the odds tell us that higher highs are coming at some point because that's what bull markets do. Conversely, if we're in a bear market and we get into an indecisive period, it's helpful to ask, does it still look like a bear market? If the answer is yes, then the odds favor a series of lower lows and lower highs. As outlined in this Charles Schwab graphic here, in the present day, there are numerous things to be optimistic about and numerous bullet points to be concerned about. Ultimately, it's the net aggregate opinion of all market participants that's going to determine whether we're going to see a series of higher highs or a series of lower lows after this period of consolidation. Thus, in early July 2018, let's turn to the charts and see what they have to say. Clients and regular viewers may remember in late 2016, early 2017, we showed this turn from 2016 using the generic and for illustrative purposes only 30, 40, and 50-week moving averages. You can see this bullish turn in 2016 looked very, very similar to the bullish turn in 2009 and the bullish turn that occurred in the spring of 2003. If you know your market history, this is an excellent longer-term entry point, and this is an excellent longer-term entry point. And as it turns out, thus far, this has been an excellent longer-term entry point. And as we noted in previous videos, this bullish turn here really didn't look anything like the bearish turn that occurred in 2007 into early 2008 using the same moving averages and the same very concerning rollover look that appeared in the early stages of the dot-com bear market. This really didn't look anything like this, and this really didn't look anything like this. Therefore, in the present day, we can learn something by asking, does the present day still look more like these three periods here, or have we morphed into something more concerning like this or this? If we fast forward to the present day, we can see July 5th, 2018 really doesn't look anything like this concerning look here in early 2008, and it really doesn't look anything like late 2000, early 2001. And there's no question that July 5th, 2018 looks a lot more like this period here and this period here. These charts and historical comparisons help us discern between the probability of a series of higher highs being made in the stock market over the long term relative to the probability of a series of lower lows being made over time. Similar concepts here, but now we're using the 50-day simple moving average in blue and the 200-day moving average in red. You can see the look of both charts similar during the peaking process in 2000 and the peaking process in late 2007, early 2008. From a trend perspective, the look we want to avoid is the 200-day rolling over in a bearish manner, the 50-day rolling over in a bearish manner, and then crossing below the 200. 50-day rolls over, 200-day rolls over, 50 crosses below. How does the exact same chart look in 2018? The answer is quite a bit better. As of July 5th, the 50-day looks like it's trying to turn back up here. The 200-day still looks strong. That's a bullish and positive slope. And unlike this period here and this period here, for now, the 50-day remains above the 200-day. And if we compare the present day to the same 50 and 200-day moving averages during a normal and 100% to be expected pullback, similar to this pullback that occurred in 1996, and this pullback in this area here that occurred in 2013, it's pretty easy to see that the present day looks a lot more like a correction within the context of an ongoing uptrend relative to the early stages of a new and longer-term bear market. Are there things to be concerned about in the present day? The answer is yes. Schwab has the handy checklist here. So let's assume on July 5th, 2018, you looked at a chart like this and said, but wait a minute, what about the possibility of a trade war? What about the flattening yield curve? Ultimately, we can take any of these concerns and handle them this way. If the yield curve becomes a showstopper, the favorable 2018 look below, this is a favorable look, will eventually morph into an unfavorable look. And that absolutely positively may happen, but the key is it hasn't happened yet. Given the fact that it's early July 2018, and the S&P 500 peaked way back on January 26, 2018, a fair question might be, is damage starting to show up on the very long-term charts that we've covered in the past in these videos? For example, this is our 8 and 9 year, for illustrative purposes only, simple yearly moving averages. In the past, we said this period here in the late 70s, early 80s had a similar look to this indecisive period here between 2009 and 2015. And back in November 2017, you could have made the argument that this period here, where blue starts to separate above red, is very, very similar to this period here. And if we look back even further, in November 2017, we said we know the longer a market goes sideways, the bigger the move we can expect to get. The longer a market goes sideways, the bigger the move we can expect to get. And if we fast forward to July 5th, 2018, and look at the exact same moving averages, we still have a very constructive look here. Really hasn't changed in any meaningful way from the analysis that was done in November of 2017. Therefore, we can still make the argument that the present day, this point A here, still looks very, very similar to this point A here that was followed by a 23-year run that saw the S&P 500 tack on an additional 580%. And this point A here, could still make the argument that it's similar to this point A here. After this, the S&P 500 rallied for an additional 18 years and tacked on almost 1,100%, telling us to keep an open mind about much better than expected outcomes in the future. This chart was constructive in 2017. It's still constructive on July 5th, 2018. And you may remember in past videos, we expanded that analysis to include indicators. Here, in the early 1980s, when we had this turn here, the Bollinger Bandwidth had a constructive turning up look. CCI moved from below 100 to above 100. And the True Strength Index had a bull cross where blue clearly moved back above red. And this constructive look here before really good things happened really didn't look anything like the peaking process with the Bollinger Bandwidth in the late 1990s. This doesn't look anything like this. CCI dropping below 100 here really doesn't look anything like this period here. And rather than getting black moving above red in a constructive manner, we have a bearish cross here. In past videos, we noted that November 2017 looked a lot like this constructive period here using these indicators, and really didn't look anything like the concerning bearish turn look that we saw before, during, and after the peak in March of 2000. If we fast forward to July 5th, 2018, we can see the present day still has a very, very constructive look. This looks like this. We're still well above 100 on CCI, and this still looks like this, telling us from a probability perspective to keep an open mind about better than expected outcomes for a long, long time. And we can also see that July 5th, 2018 really doesn't look anything like the concerning bearish turns that we could see, measure, and put in a model before, during, and after the major peak in the year 2000. Thus, all of the charts that we've covered so far side with the higher highs case relative to the lower lows case. It's important to note, we're talking about a series of higher highs and a series of lower lows. If the market was overly concerned about these negative bullet points here, we would expect to see more damage on a chart like this. That may happen, but it hasn't happened yet. And we wouldn't expect to have this constructive look from a long-term perspective on the chart of the S&P 500 as of July 5th, 2018. In 2018, the S&P 500 peaked roughly 160 days ago, telling us that market participants have had plenty of time to evaluate the threat from all of these bullet points, just as market participants evaluated all of the threats that were present in late 2007 and 2008. The S&P 500 peaked here in October of 2007. This shows us the look of the 30, 40, and 50-week generic and for illustrative purposes only simple weekly moving averages 160 days after the market peaked. We had morphed from a full-bore bullish look to a full-bore bearish look. If we look at the exact same chart, 160 days after the peak in the present day, as of July 5th, 2018, we can see this really doesn't look anything like this. And as we move forward, we'll continue to compare apples to apples. 160 days after the S&P 500 peaked, and we're spanning roughly a 6-month period in both cases. Thus, over the past 160 calendar days, if the big players thought that these concerning bullet points were going to cause the market to roll over, we would expect some of them to be migrating towards defensive assets. 160 days after the stock market peaked in 2007, 2008, we already clearly had a bias towards defensive consumer staples, XLP, relative to growth-oriented XLY in the ETF world. Do we have a similar migration taking place today? The answer is no. In fact, you can make a case that these charts are almost binary opposites. Here we have somewhat of a tight cluster here with a full-bore bearish look, and the moving averages continue to fall in favor of XLP and against XLY. In the 2018 case, we also have a tight moving average cluster look. The difference is, rather than having a full-bore bearish look, we had a full-bore bullish look. And instead of moving in a bearish direction, we've been moving in a bullish direction. And we've maintained a full-bore bullish look favoring growth-oriented XLY over XLP. This tells us a lot about the net aggregate opinion of all market participants. Similar situation in the charts that follow. 160 days after the S&P 500 peaked, we could clearly see a flip in the stock-bond ratio. It was evident in mid-December 2007. After we could see this, really bad things happened for a long period of time, all the way out to March of 2009. The present day, 160 days after the peak, using the same SPY relative to TLT ratio, looks much, much healthier. And unequivocally, from a probability perspective and based on the look of it today, favors a series of higher highs in the S&P 500 over a series of lower lows. The total stock market VTI relative to Armageddon-friendly GLD or physical gold. This is that tight look that tells us a big move could be coming. A big move did come. Unfortunately for people in the stock market, it favored gold over VTI. In all of these charts, we want to compare the look here to the look here. On July 5th, 2018, we have a much more constructive look from a probability perspective. Now we're looking at the triple Qs, or the NASDAQ 100, relative to a mutual fund that shorts small caps, or the Russell 2000. RYAFX basically moves in an identical fashion to RWM in the ETF world. If we compare the same ratios, we can see full bore bearish look here 160 days after the peak. In the present day, we have full bore bullish. This is a convincing, strong looking and sustainable trend as of July 5th, 2018. Thus far, industrials have been a laggard in the present day, or calendar year 2018. 160 days after the peak in 2007, the trend clearly favored shorting the Dow 30 using DOG over being long the S&P 500 via SPY. Do we have the same concerning rollover look in the present day? The answer is no as of July 5th, 2018. Since the model uses a weight of the evidence approach, let's take a look at small caps relative to defensive staples. Very, very concerning look here as the stock market is peaking in October 2007. After that, really bad things happened in the ratio. Present day, using the same ratio 160 days after the January peak, looks much, much better. And it may sound like a strong statement to say these charts say higher highs are coming before year end. But based on the charts that we've reviewed thus far, from a probability perspective, that's a fair statement to make based on the present day facts. If the facts change, then we will have to reassess those probabilities. The term probability is quite a bit different from the term certainty. And as we know from past videos, charts cannot predict the future, and thus we have to be very, very open to all outcomes and remain extremely flexible about new data that will come in. And the only way to do that is if we take it day by day. Clients and regular viewers may remember in the 3 market types video, we looked at the simple 8-month, 10-month, and 12-month moving averages. The 12-month here is in green, which helped us illustrate what an uptrend looks like when we have strong bullish conviction, what a downtrend looks like when we have strong bearish conviction, and what consolidation looks like, which is basically sideways type movement, which is very, very similar to what we've experienced over the past 5 months or so in calendar year 2018. Therefore, in the present day, if we look at the exact same monthly, for illustrative purposes only, moving averages, does the present day look more like 1996, a sideways transition period, or the early stages of a new bear market? If we look at the exact same moving averages as of July 5th, 2018, it's pretty easy to see that the present day looks a lot more like 1996. It really doesn't look anything like this flattening out, concerning look here with the same moving averages late in 2007. And we presently don't have any of the characteristics that were present in early 2007, with blue, the fastest moving average, being on bottom and the slopes of all three had rolled over. Presently, blue remains on top and the slopes remain constructive, as they did during normal and 100% to be expected pullbacks that occurred in calendar year 1996. Like the other charts we've reviewed, this favors the higher highs case over a series of lower lows case. We've been moving sideways in the present day, and we know that consolidation can often be followed by very satisfying gains. And even when we've been consolidating for just a few months, it can be very easy to forget that we could be in the early stages of a multiple year move following a breakout from a very long-term consolidation pattern in the NASDAQ. From this point A here to this point B here, it's 21 years. From a rally perspective, we're less than 2 years out in July of 2018. And while markets are consolidating, it's easy to say we're overdue for a bear market. As we've covered in the past, the average stock just had a bear market in calendar year 2016, a point that was highlighted in detail in this Bloomberg View piece. Just reiterating the big picture, the longer a market goes sideways, the bigger the move that we can expect to get. The average stock went sideways for a long, long period of time. You can make an argument that this breakout here is similar to this breakout here. The only difference is our consolidation box is much, much longer in duration. And relative to this move here, we're less than 2 years into what could be a multiple year breakout phase. Some new information came to light on our demographic comparisons. Remember, the baby boomers 1982 were between 22 and 39 years old. After this point here, really good things happened for a long period of time after a long period of consolidation. Similar situation here, long period of consolidation. Here, 2017, when we covered it, millennials between 13 and 35 years old. This look here, similar to this look here. And as we covered in 2016, millennials overtake baby boomers as America's largest generation. Fast forward, June 27th, 2018. Rich millennials are loading up on stocks, but still have a big chunk of cash on the sidelines. From that Yahoo Finance article, in the last year, wealthy millennials cut their cash holdings as a percentage of their portfolios from 46% to 21%. Most of their money went into equities, with their average allocation to stocks rising from 25% to 46%. The 21% that's still on the sidelines speaks to potential fuel. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.